Right, hello everybody. Welcome to today's Trend Signal Trading podcast. My name is Adrian Boothby. I'm the head of trading here at Trend Signal, and today's podcast is really, I guess, about the lockdown extensions that are affecting the markets and really affecting this supposed V-shaped recovery. It's the 29th of June 2020, and I'm joined as ever with our chief analyst, Jerry Miller. Hello, Jerry.
Hello all. Hi.
As ever, if you've this first time of listening to this podcast, what we like to do is just a bit of a run through of what's been happening over the last few days, a bit of an update on the markets and what to look out for the week ahead, really. So we just try and get into everything there. We talk about the different sort of concepts affecting the market, the different correlations that are out there. And obviously at the moment, there's a lot to talk about with the likes of COVID-19 and sort of lockdown measures, reopening or not reopening, as the case may be in the States. So Jerry, do you want to give us a quick update with what's been going on there?
Yeah, sure. Well, let's just start with what's happened overnight. The markets stumbled in the wake of news from Florida and Texas that have introduced lockdown measures, and obviously the US markets had a bit of a slip on Friday, falling 2.4%, which was the majority of last week's falls. Actually, I think the stocks fell about sort of 2.8, 3.2% in the whole of last week. 2.4% of that was on Friday, so quite a move. It's COVID-19, the infection rate's picking up there. They had been doing for probably the last week and a half. 3 weeks ago, Texas, it was pretty safe, but it just goes to show you how quickly this sort of all builds up. And so these both Texas and Florida, and they're important because they're Republican states, but they went into lockdown quite late and decided for some bizarre reason, in the second week of May, that they could ease their lockdown measures, which, as you and I have discussed, Adrian, we were a couple of weeks behind Europe, and the US were probably 3 weeks behind us. And the weird thing is, you've got the US, some of these states were easing their lockdown measures even before Europe was. So it just didn't make sense. And well, it now comes to pass that they haven't locked down long enough, and these infection rates have really picked up now. So it's that news that's been bothering the markets, and also bit of news from the Fed as well, that they've had basically said that banks are not allowed to do any share buybacks for now, which has hit the markets, hit that particular sector particularly.
And they're looking at the dividends as well, aren't they? I think.
Yeah, that's right. Dividends and share buybacks. Yeah, anything that effectively puts money back in the shareholders' pockets. I think they're concerned about the level of debt write-offs that's going to be building, which is, it'll be definitely happening, I'm afraid.
I mean, it's interesting. We talked in the subject line of today's podcast about the V-shaped recovery. I mean, obviously, the whole lockdown sort of reopening, if you like, in some of those states is really going to threaten that, isn't it, Jerry? It seems to like the Nike tick or the U might be back on the agenda.
Yeah, I definitely think so. And it's interesting. On yesterday, the US Health and Human Services Secretary, quite an interesting title, basically also rattled the markets, and that's sort of what caused the sort of gap down overnight in some of these markets, which have recovered, and as you can see, certainly recovered in the European and UK and US indices, all pointing to a slightly firmer opening, which is interesting. But he said that the Trump administration is in denial about the COVID-19 resurgence, and just to put everyone in the picture, these southern states relaxed their lockdowns early, assuming that they'd escaped, the worst of the pandemic. And remember how the pandemic hit New York. Wow. And there's a strong possibility that unless, they take action, quick action, and that means a proper lockdown, not sort of just cancelling a few things. You can't do a partial lockdown. It has to be done properly.
But I can't help but think that if there's a lot of people whose businesses are not going to be open for another few months, and who are they gonna blame? When they come to election time in November, this is the problem. I wonder if the policies taken by the Trump's administration would have been different if it wasn't an election this year, because definitely. It seems that he 100%. Just wants to focus on get businesses back open again, get the stock market as high as possible, get it moving, to make people think that he's doing a great job.
And he's engineered
secondary. I don't know.
I don't know. Well, what price of life? That's forever been debated. But he's engineered this confrontation with China, trying to underline his willingness to confront China in all its sort of devious ways of gaining share and involving itself in businesses across the globe. But it's something that Joe Biden has not commented on, and it's really been left to Trump to shoot himself in the foot. And when I listen and read reports about Mike Pence, effectively second in command at in the White House administration, he is just in denial. There is no real, how can I put it, emergence, a sort of priority in his comments. It just sounds like, well, the death rate's not increasing. It's something that we'll get control of, and it'll just put us back maybe a week or two. And I'm just thinking that's not what people should be told. They should be told, this is getting out of hand. You've got to stay indoors. But that's not going to cause people to stay indoors.
Yeah.
There's a holiday coming up. It's Independence Day. What do you think is going to happen then?
That said, it's slightly better than injecting bleach or whatever else was being said.
It's just
I know that. So before I get the complaints,
yeah, but he didn't make that, Adrian. I mean, yeah, he said he was joking. Of course, he wasn't joking. Yeah. He just didn't realise what he was saying. No, but going back to your comments about valuations and stuff and V-shape, U-shape recovery, there were some notable comments in the press, and I was just reading stuff on from Forex Factory about some of the news regarding the V-shape, U-shape recovery, and you've got some notable institutions saying that they still believe that this is going to be a V-shaped recovery. In fact, that's Morgan Stanley. A second wave is coming, but it won't derail the V-shaped recovery, they're saying. And yet there are other ones, just put it well and truly to bed, the V-shaped recovery. US COVID-19 surge likely to continue for weeks. That is likely to continue for weeks because they're not dealing with it properly. So when you look at a stock market, and remember, the stock market is a stock market, it's not the economy. The stock market is saying, this is how, this is where the shares are valued. This is where people are prepared to buy and sell. It's a fluid market all the time, but this is the valuation. And these valuations now are quite stretched, Adrian. You've come from the sort of low point around the 20th, 24th of March, and here we are now. Gosh, record highs in the Nasdaq, as we've discussed previously. That seems to be happening every week. Not in the broader market, but it's just interesting that has happened, and yet it's all based on the fact that we're going to get a decent rebound in the economy. Will the rebound in the economy justify these stock price moves and the valuations implied by these moves? And I think that the recovery is looking less likely now if these lockdown measures are introduced. And if they're not introduced, then there'll be a bigger and bigger resurgence, and eventually it'll get out of control. Then it will be all hell to pay. So I think either way, I do think that the market is going to struggle to hold on to these prices up here. I say up here compared to, late May. It's been going up sort of relentlessly in a way, hasn't it?
It has, really. I mean, I don't think many people would have ever expected the stock market to have recovered in the way that it did. That's for sure. But it certainly has. I mean, you think about that. I mean, it went from 2,190 up to 3,200. I mean, that's just absurd, really, in many ways. Yeah. But certainly, thinking about the right now, we've recovered quite a bit. So we gapped down. We look at the 4-hour chart here on the S&Ps. We can see Friday's close, and which is pretty much, we're trading just slightly above that number now. So very much just sort of a risk-off move first thing, but we're then retreating back as though nothing's really happened over the weekend. And we saw similarly with foreign exchange as well. So the sort of risk-off currencies like well, sort of the riskier ones like Aussie dollar and New Zealand dollar, they got a bit hit this morning in the same way as stocks. But again, they've kind of recovered a little bit off their lows as well today. Big moves on the pound though today, Jerry.
I mean, I can only think that this is the nerves ahead of the Brexit talks, which have started. Is there feedback on that? And when I talk about the Brexit talks, I'm talking about David Frost, the UK's negotiator, is actually meeting in person with Michel Barnier, the EU's chief negotiator. But the press, certainly the Financial Times, have talked quite positively about this ever since Boris Johnson's intervention with the president of the EU Commission, was it a week or 2 weeks ago, that seems to put it all back in play again. What sort of deal will be achieved? But I think they will get a deal at some stage. There seems to be both sides prepared to compromise. So you could almost, I've sort of assumed that that's going to happen. So to see this sterling weakness, is it a reflection of more turbulence to come? I know the UK is regarded as one of the weaker, potentially one of the economies to be hit most by the pandemic because of its reliance on the consumer and consumer spending, and a higher percentage of service sector industry that's been sort of furloughed, big hospitality, travel, leisure sector. So it's probably a combination of all of those, Adrian. But I noticed that sterling's lost. It's about 1% against the euro this morning.
Yeah, euro is very strong. Sterling's pretty weak. So yeah, massive moves. There was a fantastic buy on our S4 Accelerator strategy just on Friday evening, and I mean, and it's just paused for a few hours, but you can see the size of the two candlesticks, the 10 p.m. closing candle and this current one, massive moves, really, relative terms.
But you're right. It seems that it's particularly weak against the euro. So the euro is quite strong generally this morning, or today, I should say.
And actually, a bit of decent volatility in the FX markets this week. But last week was quite a quiet one, wasn't it, Jerry? So we saw stocks go down, but we saw pretty flat sort of dollar moves on euro dollar, pound dollar, dollar yen.
Yeah, that's right. I mean, stocks, as we mentioned at the beginning of this piece, the US indices were down sort of 2.8, 3.3%, but currencies, which are a lot less volatile, really had a particularly quiet week last week. Sterling, which, I keep on reading these comments. Bank of America put out another one saying that the British pound was like an emerging market currency, but there was quite an interesting opinion piece in the FT this morning saying that that's completely wrong. The fact is, it's going through some turbulence, and there are more unknowns about sterling than there are about other currencies. So it is reflected in the movement in the currency, but it's certainly not behaving like it is not an emerging market currency. It's a misunderstanding, really. If anything, it's trading the way foreign exchange markets used to trade, a decade ago, but the volatility in foreign exchange markets has eroded over time. That's for sure.
And why is that? Is that down to the fact that interest rates are low generally across the?
If you think about it, Adrian, when there is a gap between relative interest rates, so if you're trading the sterling against the Japanese yen, for example, with yen rates really, really low and sterling rates quite high, there's plenty of room for arbitrage, the carry trades, and all sorts of reasons for buying and selling different currencies. With rates being crushed, the air has been sucked out of all those sort of strategies where you've got interest rates in virtually all economies crushed down to the very bottom of the chart. So they've all been stamped on, as it were. There's no daylight between any of them. So it really removes any sort of arbitrage or carry trading opportunities. There is still a little bit of that, but relative to what there could be, it's quite small.
And what about the commodities? So gold broke out last week, didn't it? So it sort of broke to sort of new highs in comparison to they've been trading relatively strongly anyway, of course. And whilst the stock market's been coming off a little bit, gold just keeps rising.
Well, it's sort of feeding itself in a way. The more it goes up, the more it reaches multi-year highs. I mean, I think we hit highest levels we've seen since October 2012, Adrian, in gold. So obviously won't see it on a daily chart, but that's you're going back 7 years and sort of 8 months. It's a big move, something that I hadn't foreseen, but then again, I hadn't foreseen the pandemic, the global pandemic. But it's just interesting the way it continues to attract interest, and partly the dollar's not really having much of an impact, but as a safe haven play, is it safe haven buying? Is the stock market, living on borrowed time? Is gold right and the stock market right? They both can't be right. And we've mentioned it before now. If there is a sudden fall in equities, which would be what we call as a risk-off move, as investors take their money out of riskier assets, i.e. Equities, and put them into bonds yielding nothing, if not negatively yielding, put that into cash, into dollars or Swiss francs or Japanese yen, but normally then they buy gold. But if the dollar's rallying, it makes it puts pressure on gold as well. So I'm not convinced in the short term about gold. My impression is that it might be trading quite a way ahead of the situation, and if there is a sudden knee-jerk fall in equities, I'm not sure how much gold would benefit from it.
Yeah. Okay. And quite. And what about oil? It was down a bit last week. So what's that for?
Well, it's basically been tracking equities. Obviously, when equities fall, the oil sector falls. It's reflected in the oil price. It's going to be less demand for oil. If there's less demand, the price will go down. So it's not really surprising. News over the weekend, though, was quite interesting. Chesapeake Energy, many of you might have listening to this might have heard of that producer. It's one of I think it actually is the biggest US oil producer. So one of the big frackers that produces a lot of oil. Went into Chapter 11 on Sunday. That's Chapter 11 insolvency protection whilst it reorganizes its affairs. It has been saddled with really unsustainable debt for 4 or 5 years, really. And it just can't make a profit at these sort of prices. It's unable to invest in new wells, which is the lifeblood of any fracking business. So it decided.
We discussed in previous podcasts that the cost of fracking is about $50 a barrel. So isn't it? Is it 50? They can't survive at 38, can they? Unless they're getting huge subsidy.
On average, it's sort of anywhere between sort of 35 and 50, depending on which sort of area they're in. But it's quite a lot more expensive than the cheap oil producers in the Middle East that stick a whole tube in the ground and up comes oil. It's an expensive business extracting it, and these companies have borrowed huge amounts of money. But this is something that's been a long time coming with Chesapeake, and I just think it was inevitable when the price collapsed as it did in the wake of the pandemic crisis, and maybe this will just give it that sort of time that it needs to try and reorganize itself. You look at, I was looking at a chart on Chesapeake. They got pretty much killed over the last 5 years. So most shareholders are probably resigned to losing most of their money, but in Chapter 11, they're going to lose the rest of what they've got left. I don't know, but never know. A lot of companies that have gone into Chapter 11, like Hertz, which went into Chapter 11, what was it, sort of 6 weeks ago, the share price has gone through the roof. So ever since its rescue, but already the lenders are queuing up to lend money to Chesapeake when it's reorganized itself. So for all those OPEC plus producers that are just waiting to see a collapse in US production, it may not be that for that long. I don't know, but they'll probably know more than I do.
Maybe.
Yeah.
Okay, so let's have a quick look at some of the highlights from last week before we get into this coming week's main event. So last week, there was some good data out there, beating expectations on some of the service and manufacturing PMI data, Jerry, on Tuesday last
Yeah.
week. That was pretty positive. In fact, quite a lot of positive stuff last week, really.
Yeah, I just goes to show you how difficult it is to forecast what's coming out, and there's been such horrendous moves with unemployment data, just the likes that I've never seen, and you will never see, because you're going to be around a lot longer than me, Adrian, in the future. You will ever see again. I mean, it's just extraordinary. So, it's not a critique on economists and analysts with their forecasts, but it's more of how impressive the rebound has been. But what I would say, apart from the French numbers, those sectors, the manufacturing and service sectors, are still in recession, are still contracting. Yeah, so there's still a long way to go. And remember, there are hotspots of COVID-19 popping up in several areas in Europe. Some in Germany, some in France. In all of these sort of meat packing factories and stuff like that that have typically cold environments where the virus flourishes, where there are a lot of people around. So we're not out of the woods yet, that's for sure.
Yeah, absolutely. Okay, and then we'll move on to this coming week in a second. But University of Michigan consumer sentiment just slightly weaker than expected, Jerry. So can you just 2 seconds on why this is quite an important number?
Well, if the consumer is happy and is confident and is okay with his or her lot, they'll spend money. If they spend money, they buy goods, they buy services, and the companies that they buy those goods and services off are likely to, with more revenue, are going to make more profits, better for the stock market. And so it's a good leading indicator. So we look at these consumer sentiment readings, knowing that they're telling us what's going to happen sort of in the months to come. So we're interested in the University of Michigan, which puts out this very detailed consumer sentiment reading. And this is a revision from the previous reading, Adrian. So not too bad a revision, but you can click on the graph on the right hand side. You can see what that looks like. And it's just collapsed, but it's recovering now. But it's still got a long way to go to get back to those levels that we've been used to over the last sort of 5, 6, 7, 8 years, really since 2014. But again, it is such a self-inflicted wound, this, to the extent that governments deliberately close down vast swathes of their economy to protect the population from this virus, and that's what the lockdown's called.
Yeah, well, absolutely. Okay, so finally then, we've got the week ahead. A few bits. The Bank of England governor's already spoken. Maybe there were some pearls of wisdom that led to the sterling move.
Yeah, I can't see anything that he said from that's a cause for the sterling weakness. But again, it might be a reaction to Johnson's comments, possibly.
Yeah. Otherwise, sort of main events, Jerry, do you want to quickly run through those?
Yeah, sure. I'll head up. So we've already talked about the Brexit talks that started today. Tomorrow, very early doors, I should say. We have the Chinese manufacturing and services PMI data. It's produced by the state as opposed to the independent one produced by Cakesin, which is a bit more respected because the Chinese state tends to release data that matches its forecast because they're not wrong. They're not wrong, are they? So we'll wake up tomorrow morning. That data comes out overnight, so we'll feel the effects of whatever that might have been in the morning or not, possibly depending on how far away it is from expectations. We then have tomorrow evening, after our market shut at 5:30, we've got Jerome Powell, the chairman of the Federal Reserve, the US Central Bank. He's testifying in Congress to the House Financial Services Committee. Quite an important committee, that one, actually, and that has the potential to cause a few ripples in equity markets and foreign exchange markets, certainly with the dollar. So at 5:30 tomorrow afternoon, that's one to watch. This is the week of being the first Friday of the new month. This week, we have the payroll data out in the US, and the US payroll data is important because it is one of the mandates of the US Central Bank, the Federal Reserve, to try and foster full employment. So employment data does affect what the central bank does with interest rates. Let's just make that clear. Which brings me on to ADP non-farm employment change on Wednesday. This is the private payroll company reading that it's a bit more volatile than the government's own Bureau of Labour Statistics that is going to release their data on Thursday this week, not Friday, because it's a bank holiday in the US. But so ADP certainly seeing the same sort of increase in employment as you'd expect as this lockdown eases across the US. You can click on the graph on the right-hand side, Adrian, on ADP, and you can see this just 20 million. Anyway, so the forecast is for a 3 million rise following a 2.76 million contraction the previous month, which sort of is basically in line with most forecasts and what you'd expect to see. On to Thursday. We don't normally get non-farm employment change or unemployment data in the US on a Thursday, but it's a bank holiday Friday, which is the day before Independence Day on the 4th of July, which is Saturday. So Friday markets are closed. Thursday, we got the unemployment data. 3 million increase in employment, which, you know, having had 20 odd million unemployed, a lot of those workers are now going back to work, Adrian. And
Yeah,
the important thing is you've got to note here, this is the same time as we get the initial claims. Do you see the unemployment claims there at the bottom there? That is the weekly data that largely makes up the monthly data. Now, people are going to look at this and think, well, so you're telling me there's 1.3 million, I think that's what it means, 1.3 million in new claims. And that basically is because there are still people who are being made redundant or are being furloughed and are claiming unemployment benefit. But that doesn't mean that the number of people employed isn't going up, because there are a lot of people who have previously claimed for unemployment benefits who've gone back to work. So the unemployment claims or initial claims are different to non-farm employment, so that there is a distinction. The key thing is if you click on that graph again on the right-hand side, Adrian, you can see exactly what's happening with. If you click on the non-farm employment change graph, that's the one. So you can see there how catastrophic, a bit like the ADP. You could see the 20 million jobless. Now we're seeing a rise of 2.5. We're looking for 3 million coming this week. That's the expectation. That's that little brown mark there that denotes the expectation. But that's consistent with what most economists are expecting. Whether we get a U or V-shaped recovery very much depends. I've got a feeling it's going to be a V-shaped recovery that looks like a U.
They'll all be calling it a V-shaped, won't they? Well, the Republicans will anyway, that's for sure.
Yeah, there's a new.
No, what shape it is, it'll be V.
Yeah, I think it's a V. No, it's a U. No, it's a V. Yeah. Okay. Whatever you want, Donald, it's yours, mate. Well, he's not doing that well in the polls, so you might start to wonder whether he has chosen the right path. Maybe remaining like Sleepy Joe, just stay in the limelight and let your rival shoot himself in the foot. One of the polls puts Joe Biden 14 points ahead of Trump.
14. That's even more than it had been, isn't it? It's been sort of 10 or 11 for the last couple of weeks, isn't it?
Yeah. But he does well on the campaign when it all gets going, and if there's any head-to-head stuff, he'll do well, Trump. But some people are, some analysts are saying that he might have already lost it, which is interesting.
Well, my guess is it'll be good for the stock market until he sort of gives up, and then he'll keep doing more and more stimulus for the stock market, and then as soon as that's probably the end of it, my guess is there'll be a big old sell as soon as Biden gets in, if he gets in.
Well, yeah, that'll be really interesting. There's so much damage being wrought on international relationships. The internet, the isolationist sort of policies that Trump's pushed for, dropping NAFTA, the combative style with the EU. It's just with everyone, and it's just been an extraordinary 4 years of flux and change.
And Twitter.
Yeah, running the government by Twitter from your bed at 3 o'clock in the morning. Maybe Sleepy Joe. Maybe Trump should be a bit more sleepy. He'd probably be doing better. Yeah, there you go.
He drinks I think, what is it? Something like 12 cans of Diet Coke a day. I think I watched a video on. Yeah. It's a remarkable video I watched on Facebook a few weeks ago, and there are these two guys who had to eat what he eats during the day and what he drinks, which is just horrendous, basically.
Well, I know he doesn't drink a drop of alcohol. He's not drunk alcohol for a long time.
He only drinks Diet Coke, apparently. And for lunch, they served up pizza for one person, or the other one was McDonald's. But with the pizza, they just scraped off the topping, because he doesn't actually eat the bread base. He just eats the topping of the pizza. And the other one had some McDonald's burgers, and it was 4 burgers, but he didn't eat the bread, so he just had to eat the meat with like.
What is the point of having a pizza without the bread, the dough?
Just melted cheese. I just have some melted cheese.
Yeah, melted cheese and meat. That's interesting. Wow. Yeah. Wow.
We digress.
If he does lose, we're going to miss him. Gosh, Twitter will be bereft of.
We'll short Twitter.
Yeah,
we'll short Twitter when Biden gets in.
Exactly.
Right. Anything else to add?
No, that's it pretty much. With the markets, US markets shut on Friday, European and UK markets are likely to be quieter than normal. But as I've said before, it doesn't mean you're not going to get any news or announcement that could destabilize the markets. And if it happens on a day when the US markets are closed, you will get an even bigger reaction in our markets. So not a day
to slow it down.
Correct. Yes. So not a day to go gardening, really. If you're a trader, you've got to keep focused, especially so when the US markets are shut, because you can still get some big moves, especially on a Friday. It's very unusual to have a Friday holiday.
Yeah, absolutely. Okay, right, that's pretty much it then from us. So as ever, we are hosting some events this week. I'm going to go through these slides, which we haven't looked at today, but that's okay. If you'd like to find out more about Trend Signal and how we teach people to trade beyond just today's podcast, then we'd love to welcome you to one of our live trading webinars. So you can register. We've got a short link on screen now. So there's bit.ly, so bit.ly /LearnTS, so bit.ly/LearnTS, and we'll teach you one of our trading strategies, how we use it, how we apply it to the FX index and commodity markets, so that potentially you could use it too to help boost your trading results as well. Plus, as ever, the podcast, if it's your first time of accessing it and you'd like to know what we're on a number of different places. You can listen to us on iTunes, you can listen to us on SoundCloud, on Spotify, and you can even watch it too on YouTube and our website as well. So just search for the Trend Signal podcast and access it on your favorite podcast provider. If you want to go to our website, just go to trend-signal.com/trendsignal-blog. A bit of a mouthful there. So trend-signal.com/trendsignal-blog. But that's it. Otherwise, everybody have a great week's trading, and hopefully we'll see you at one of our events, or if not, at the podcast this time next week. So bye-bye for now.